very carefully, because what I'm about to tell you could be the difference between a comfortable retirement and a complete financial disaster. I'm Kevin O'Leary, and I've been investing for over 40 years. I've made millions, I've lost millions, and I've learned every single lesson the hard way so you don't have to. And today I'm going to cut through all the garbage, all the noise, all the complexity that the financial industry throws at you, and I'm going to give you something simple. 2 funds. That's it, 2 Vanguard funds. If you're over 65 years old, this is all you need to know. Now, before I tell you exactly which funds these are and why they're the only ones that matter, I need you to do something for me right now. Hit that subscribe button. Smash it, because this channel is about real talk, real money, and real results. I don't waste your time, and I expect you not to waste mine. So subscribe, turn on notifications, and let's get into this together. Here's the truth that nobody in the financial services industry wants you to hear. When you're over 65, you are in a completely different game than someone who's 30 or 40. You don't have time on your side anymore. You can't afford to take big risks. You can't afford to be cute with your investments. You can't afford to chase the latest hot stock or cryptocurrency or whatever garbage some influencer is selling you on social media. Your job now, your only job is to preserve what you have and generate income that you can live on without running out of money before you run out of life. That's it, simple. But here's where most people screw it up. They overcomplicate everything. They've got 15 funds, 20 stocks, bonds they don't understand, alternative investments that their broker convinced them to buy. It's a mess. And you know what a mess gets you. Stress, confusion, and usually lousy returns with way too much risk. I see this all the time. People come to me and they show me their portfolios, and it looks like a bomb went off in a mutual fund store. They've got growth funds, value funds, international funds, small cap, large cap, sector funds, you name it. And I ask them, why do you own all this? And they look at me with blank faces. They have no idea. Their advisor told them to buy it, so they did. That's not investing. That's gambling with a suit on. When you're over 65, simplicity is not just nice to have. It's essential. You need to know exactly what you own, why you own it, and what it's going to do for you. No surprises, no complexity, no sleepless nights wondering if you're going to be okay. That's why I'm giving you 2 funds, not 10, not 5, 2, because 2 funds, if they're the right funds, can give you everything you need: diversification, income, stability, and peace of mind. Now, I know what some of you are thinking, Kevin, 2 funds, that sounds too simple. There's got to be a catch. Let me tell you something. The catch is that simple works. Simple is powerful. Simple is what keeps you alive in the markets when everyone else is panicking and making stupid decisions. Warren Buffett, one of the greatest investors of all time, has said that when he dies, he wants his wife's money put into a simple index fund, not some complicated hedge fund strategy, not some exotic investment that requires a PhD to understand a simple index fund. It's good enough for Warren Buffett's Emily. It's good enough for you. The financial industry doesn't want you to now this, because they make their money in complexity. They make their money by selling you products, charging you fees, ND keeping you confused so you keep oming back for more advice. But I'm not selling you anything. I'm giving you the Ruth, and the truth is, at 65, you need to be boring. Boring is beautiful. Boring keeps you safe. Boring lets you sleep at night. I've been on Shark Tank for years. I've invested in hundreds of companies. I've seen businesses succeed and fail. And you know what I've learned? The businesses that survive are the ones that keep it simple, focus on the fundamentals, and don't try to be everything to everyone. The same principle applies to your retirement portfolio. So what are these 2 funds? Before I tell you, let me explain what we're trying to accomplish here. You need two things in retirement. Number one, you need growth. Not crazy growth, not trying to double your money every year growth, but steady, reliable growth that keeps pace with inflation and keeps your purchasing power intact. Because here's the scary truth. If you're 65, today you could live another 20, 25, maybe 30 years. That's a long time. And if your money isn't growing at all, inflation's going to eat you alive. A dollar today is not going to be worth $1 in 20 years. So you need some growth. But number two, and this is just as important, you need stability. You need to know that when the market has a bad year, and it will have bad years, you're not going to lose half your nest egg. You need to be able to ride out the storms without panicking and selling at the worst possible time. That's where most people get it wrong. They either go all in on growth and take way too much risk, or they go all in on safety and earn nothing watching inflation slowly destroy their wealth. What you need is balance. You need the right mix of growth and stability. And that's exactly what these two Vanguard funds are going to give you. Now, Vanguard is not paying me to say this. I don't work for Vanguard, but I respect what they've built. They pioneered the index fund. They have some of the lowest fees in the industry, and low fees matter. Every dollar you pay in fees is a dollar. That's not working for you. Over 20 or 30 years, high fees can cost you tens of thousands, even hundreds of thousands of dollars. Vanguard keeps it simple and keeps it cheap, which is exactly what you need. Let me also be very clear about something. I'm not your financial advisor. I don't know your personal situation. I don't know how much money you have, what your expenses are, whether you have a pension, social security, other sources of income. So before you do anything with your money, you need to sit down and understand your own situation. But what I'm giving you today is a framework, a starting point that works for the vast majority of people over 65 who want simplicity, safety, and steady growth. This is the foundation. You can adjust from here based on your specific needs, but this is where you start. All right, let's get into the first fund. But before I do, if you're finding this valuable, if you're realizing that maybe your portfolio is too complicated and you need to simplify, do me a favor, hit that like button right now. It helps this video reach more people who need to hear this message. And drop a comment below. Tell me, how many funds do you currently own? Are you over 65? Let me know. I read the comments and I want to hear from you. Now let's talk about fund number one. The first fund you need to own is the Vanguard Total Bond Market Index Fund. Now I can already hear some of you groaning. Bonds, Kevin, bonds are boring. Bonds don't make money. I want growth. Listen to me. You're over 65. Boring is exactly what you want. And let me tell you something else. Bonds absolutely do make money when used correctly. They're not going to make you rich overnight, but that's not the point anymore. The point is preservation and income. Let me break down exactly what this fund does and why it's critical for your portfolio. The Vanguard Total Bond Market Index Fund gives you exposure to thousands of bonds, government bonds, corporate bonds, mortgage-backed, securities, the whole spectrum of the investment-grade bond market. When you own this fund, you're essentially lending money to the United States government, to corporations, to various entities, and they're paying you interest for the privilege of borrowing your money. It's that simple. Now, the beauty of this fund is diversification. You're not putting all your eggs in one basket. You're spread across thousands of different bonds with different maturity dates, different interest rates, different issuers. This means if one bond defaults, which is rare with investment-grade bonds, it's a tiny fraction of your holdings. You barely feel it. Here's what I love about bonds at your age. They provide stability. When the stock market goes crazy, when it drops 10%, 15%, 20% in a bad year, bonds typically hold their value much better Sometimes they even go up when stocks go down because investors flee to safety. This is what we call negative correlation, and it's your best friend in retirement. You need something in your portfolio that zigs when stocks zag. That's bonds. They smooth out the ride. They reduce volatility. They let you sleep at night when CNBC is screaming about market crashes. Now let's talk about the income component, because this is crucial. Bonds pay interest. The Vanguard Total Bond Market Index Fund takes all that interest from thousands of bonds and distributes it to you regularly. This is income you can live on. This is money that hits your account, whether the stock market is up, down, or sideways. That predictability is gold. When you're retired and living on a fixed income, you know what's coming in. You can plan your expenses. You can budget, no surprises. And right now, with interest rates where they've been, Bo, NDS are actually paying decent yields again. For a long time, bonds paid almost nothing, but things have changed. The interest rate environment has shifted and bond yields have become attractive. Again, let me give you some perspective on returns, because I know you want numbers. Historically, the total bond market has returned somewhere in the range of 4 to 5% annually over the long term. Now, that's not going to set the world on fire. It's not going to double your money in 3 years. But remember what we're trying to do here? We're trying to preserve capital, generate income, and reduce risk. 4 to 5% with very low volatility is a beautiful thing when you're over 65. Compare that to keeping your money in a savings account, earning next to nothing, or worse, taking huge risks, trying to chase 10 or 15% returns and potentially losing 30% in a bad year. I'll take boring and steady any day. Here's another thing people don't understand about bonds. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. This is inverse relationship, and it confuses people. But here's why it doesn't matter as much as you think for this fund. The Vanguard Total Bond Market Index Fund holds bonds of all different maturities, some short-term, some intermediate, some long-term. This mix means it's not overly sensitive to interest rate changes. Yes, if rates spike suddenly, the fund's value might dip temporarily, but you're holding this for income and stability, not to trade it. And over time, as bonds mature and get replaced with new bonds at current rates, the fund adjusts. You're not locked into old, low-yielding bonds forever. What percentage of your portfolio should be in this bond fund? This is where everyone's situation is a little different, but I'm going to give you a rule of thumb that works for most people over 65. You want somewhere between 40 and 60% of your portfolio in bonds. Now, I know some old school advisors say your bond allocation should equal your age. So if you're 65% bonds, if you're 70% bonds, I think that's too conservative for most people. Remember, you're likely going to live another 20 or 30 years. You can't just hide in bonds and earn nothing above inflation. You need some growth, which is where our second fund comes in. But we'll get to that in a minute. For now, understand it. Having 40 to 60% in the Vanguard Total Bond Market Index Fund gives you a solid foundation of stability and income. If you're more conservative, if the thought of losing money keeps you up at night, go towards 60%. If you're comfortable with a little more risk and you want more growth potential, go toward 40%, but stay in that range. Don't go below 40% bonds at your age because you need that cushion. And don't go above 60% because you need some growth to outpace inflation. Let me also talk about fees for a second, because this is important. The expense ratio on the Vanguard Total Bond Market Index Fund is incredibly low. We're talking about a fraction of a percent. Compare that to actively managed bond funds that charge 1% or more. That difference compounds over time. If you have a 100 $100,000 in this fund, you're paying maybe $50 or $60 a year in fees. That's it. An actively managed fund might charge you $1,000 or more. Where's that extra money going? Into the fund manager's pocket, not yours. And study after study shows that actively managed bond funds don't outperform index funds over the long term. So why pay more for worse results? You wouldn't. That's why this fund makes sense. Now, I want to address something that some of you might be thinking, Kevin, what about individual bonds? Why not just buy bonds directly instead of a fund? It's a fair question if you have a very large portfolio, millions of dollars, and you have the time and expertise to manage a bond ladder. Buying individual bonds can work, but for most people, it's not practical. Building a diversified bond portfolio on your own requires a lot of capital and a lot of knowledge. You need to understand credit ratings, yield, curves, call provisions, maturity dates, all kinds of technical stuff. The Vanguard Total Bond Market Index Fund does all of that for you. It's instant diversification, professional management, and you can get started with a relatively small amount of money. It's the smart, simple choice. Here's what I want you to understand. And this bond fund is your anchor. It's the part of your portfolio that keeps you grounded. When everything else is going crazy, it's not exciting. You're not going to brag about it at parties, but it's doing the most important job, which is protecting your wealth and providing steady income. In my years of investing, I've learned that the boring stuff, the unsexy stuff, is usually what makes you money over the long run. The flashy stuff, the exciting stuff, that's usually what loses you money. So to recap on fund number one, the Vanguard Total Bond Market Index Fund, you want 40 to 60% of your portfolio here, depending on your risk tolerance. It gives you thousands of bonds, incredible diversification, low fees, steady income, and stability. This is your defense. This is what protects you when the market gets ugly. And trust me, the market will get ugly at some point. It always does. When that happens, you'll be glad you own this fund. Now, defense alone won't get you to the finish line. You also need some offense. You need growth. And that's where fund number two comes in, and it's the perfect complement to what we just talked about. Fund number two is the Vanguard Total Stock Market Index Fund. This is your growth engine. This is the fund that's going to help your money keep pace with inflation and actually grow over the next 20 or 30 years of your retirement. Now, I know what some of you are thinking, Kevin, I'm over 65. Shouldn't I be out of stocks? Absolutely not. That's old thinking, and it's dangerous thinking. If you're 65 today and you live to 90, that's 25 years. That's a long time horizon. You cannot afford to be 100% in bonds earning 4 or 5% when inflation is running at 3%. You're barely staying ahead. You need equities. You need stocks, but you need the right stocks in the right way. The Vanguard Total Stock Market Index Fund gives you ownership in virtually every publicly traded company in America. We're talking about thousands of companies. Apple, Microsoft, Amazon, Tesla, Johnson & Johnson, Coca-Cola, small companies, medium companies, large companies, technology, healthcare, consumer goods, energy, financials, everything. When you buy this fund, you own a piece of the entire American economy. And let me tell you something, betting against the American economy over the long term has been a losing bet for over 100 years. Yes, we have recessions. Yes, we have market crashes. Yes, we have bad years. But over time, over decades, the American economy grows and American companies make money. That's the bet you're making with this fund. Here's why this fund is perfect for someone over 65. First, it's diversified. You're not picking individual stocks and hoping you get lucky. You're not putting all your money in one sector that could blow up. You're spread across the entire market. If one company goes bankrupt, it's a tiny fraction of your holdings. You don't even notice it. Second, it's low cost. The expense ratio is ridiculously low. Just like the bond fund, you're not paying some hotshot fund manager 2% a year to try and beat the market when statistically they probably won't. You're paying a fraction of a percent to own the whole market. Third, it's passive. You don't have to do anything. You don't have to watch CNBC every day. You don't have to read earnings reports. You don't have to stress about whether to buy or sell. You just own it and let it do its thing. Now, let's talk about historical returns, because this is where it gets interesting. Over the long term, the total stock market has returned about 9 to 10% annually. Some years it's up 30%, some years it's down 20%. But over time, over decades, it averages out to 9 to 10%. That's powerful. That's how you build and preserve wealth. But here's the catch. You have to be able to stomach the volatility. Stocks go up and down. Sometimes they go down a lot. In a bad year, you could see your stock holdings drop 20, 30, even 40%. This is why you can't have all your money in stocks at 65. You need that bond cushion we talked about in fund number 1 to smooth out the ride. So how much should you have in the Vanguard Total Stock Market Index Fund? Remember, we said 40 to 60% in bonds. That means the remainder, 40 to 60%, goes into this stock fund. If you're more aggressive, if you want more growth potential and you can handle more volatility, you go 60% stocks and 40% bonds. If you're more conservative, if you want more stability and less drama, you go 40% stocks and 60% bonds. Most people over 65 should be somewhere in the middle. 5,050 is a perfectly reasonable allocation. It gives you balance, it gives you growth without taking crazy risks. Let me give you a real-world example so you can see how this works. Let's say you have $500,000 saved for retirement. You put $250,000 in the Vanguard Total Bond Market Index Fund and $250,000 in the Vanguard Total Stock Market Index Fund, 5,050 split. In a good year for stocks, let's say stocks are up 15% and bonds are up 5%. Your stock portion grows to $287,500. Your bond portion grows to $262,500. Your total portfolio is now $550,000. You made $50,000. Nice. But now let's look at a bad year. Stocks drop 20% and bonds are flat. Your stock portion drops to $200,000. Your bond portion stays at $250,000. Your total portfolio is $450,000. You lost $50,000. That hurts. But here's the key. You didn't lose a H100,000 because you had bonds cushioning the blow. And more importantly, you don't panic and sell because you know you have enough in bonds to cover your living expenses for several years while you wait for stocks to recover. And they always recover, always. It might take a year, it might take 3 years, but they recover. This is the genius of the two-fund portfolio. The bonds give you stability and income. The stocks give you growth. Together, they give you everything you need without the complexity, without the stress, without the sleepless nights. You're not trying to time the market. You're not trying to pick the next hot stock. You're not trying to outsmart Wall Street. You're simply participating in the long-term growth of bonds and stocks in a balanced, sensible way. This is how you win the game at 65%. Now let me talk about rebalancing, because this is important and a lot of people miss this. Over time, your allocation is going to drift. If stocks have a great year, suddenly you might be 65% stocks and 35% bonds instead of your target 50-50ths. Or if stocks have a terrible year, you might be 35% stocks and 65% bonds. Once a year, maybe twice a year, you need to rebalance back to your target allocation. How do you do this? You sell a little bit of whatever went up and buy a little bit of whatever went down to get back to your target percentages. This forces you to do what every successful investor does: buy low and sell high. You're selling the thing that went up and buying the thing that went down. It's counterintuitive, but it works. Rebalancing also keeps your risk in check. If you never rebalance and stocks go on a 10-year run, you could end up with 80 or 90% in stocks without realizing it. Then, when the inevitable crash comes, you get crushed. Rebalancing prevents that. It keeps you disciplined. It keeps you on track. Most brokerages will do this automatically for you if you set it up. Vanguard certainly will. But even if you have to do it manually, it's not hard. Once a year, look at your percentages, do the math, make the trades, takes an hour. That's it. Let me also address dividends, because this is a nice bonus with the stock fund. Many of the companies in the Vanguard Total Stock Market Index Fund pay dividends. That's cash paid out to shareholders just for owning the stock. The fund collects all those dividends and distributes them to you. This is additional income on top of the interest from your bond fund. You can take that cash and spend it, or you can reinvest it to buy more shares and compound your growth. Either way, it's money in your pocket. And dividends tend to be more stable than stock prices. Even in bad years, many companies keep paying dividends. So you're getting paid to wait for the market to recover. Here's what I want you to take away from these two funds. The Vanguard Total Bond Market Index Fund and the Vanguard Total Stock Market Index Fund are all you need. You don't need anything else. You don't need international funds. You don't need sector funds. You don't need alternative investments. You don't need gold. You don't need cryptocurrency. You don't need anything that some advisor is trying to sell you. These two funds give you everything. Diversification across thousands of securities, low costs, balance between growth and stability, simplicity. You can understand and manage yourself. This is the formula. This is how you protect your wealth and make it last for the rest of your life. Now, let me be very clear about the action steps, because I want you to walk away from this video knowing exactly what to do. Step 1, figure out how much you have saved for retirement. Add up all your accounts. Step 2, decide on your allocation. Are you 50-50, 6,040, 4,060? Pick one based on your risk tolerance. Step 3, open an account with Vanguard if you don't already have one. It's easy. You can do it online. Step 4, buy these two funds in your chosen allocation. Step 5, set up automatic rebalancing, or put a reminder in your calendar to rebalance once a year. That's it, 5 steps. You can do this in an afternoon. And here's the beautiful part. Once it's set up, you're done. You don't have to watch the market every day. You don't have to read financial news. You don't have to stress. You just live your life knowing that your money is working for you in a smart, simple, proven way. You can travel, spend time with your grandkids, pursue your hobbies, whatever you want to do in retirement. Your portfolio is on autopilot, doing exactly what it's supposed to do. I've been investing for over 40 years. I've seen every market condition you can imagine: booms, busts, crashes, recoveries, everything. And I can tell you with absolute certainty that this two-fund approach works. It's not sexy, it's not exciting, but it works. And at 65, working is all that matters. Your job is not to get rich quick. Your job is to not get poor slow. This strategy accomplishes that goal. So, here's my final challenge to you. If this makes sense, if you're ready to simplify your financial life and stop stressing about money, I need you to do 3 things right now. First, hit that subscribe button and become a member of this channel. We're building a community of people who want straight talk about money. No BS, no gimmicks, just the truth. Second, smash that like button so more people can see this video and learn this strategy. And third, leave a comment below. Tell me, are you going to implement this two-fund strategy? Do you have questions? Let me know. I read every comment and I want to hear from you. Remember, you've worked your whole Life to build your nest egg. Don't let Wall Street complicate it and charge you fees to underperform. Take control. Keep it simple. Own these 2 funds and enjoy your retirement knowing your money is safe, growing, and working for you. That's it. That's the secret. 2 funds, simple, safe, and smart. Now go make it happen.